U.S. government debt held by the public just topped 100% of GDP. As of March 31st, the country's publicly held debt was $31.3 trillion, while GDP over the preceding year was $31.2 trillion. Over the next 10 years, this number is expected to climb a further $25 trillion to $56 trillion, or to 120% of GDP. The previous MacroWatch video explained that your wealth is built on government debt. Therefore, if government debt does surge by another $25 trillion by 2036, then your wealth is likely to continue to surge too. But will it be possible for the government to finance so much new debt? Who will buy it all? This video will answer those questions. It will begin by showing who has financed the government's current outstanding debt. It will then explain who will finance all the government's new debt during the years ahead. At the end of 2025, total government debt was $38.5 trillion. Intragovernmental debt was $7.6 trillion, and debt held by the public, the difference between total government debt and intragovernmental debt, was $30.9 trillion. Intragovernmental holdings are Treasury securities held by government trust funds, like Social Security. So this is money the government owes to itself, not to domestic investors or foreign creditors. Therefore, while total government debt often captures the headlines, it's government debt held by the public that matters in this analysis, since this is the debt that the government must find buyers for. This chart shows the growth in government debt held by the public since 1970. And this chart compares government debt held by the public and total Treasury securities outstanding from 1990. Clearly, they are nearly the same amount every year. So when we think about who will finance the government's debt, what we're really asking is who will buy the Treasury securities the government will sell during the years ahead. Let's begin by looking at who owns all the Treasury securities that exist today. Here's the complete list. The rest of the world, or in other words, other countries, own $9.2 trillion worth of U.S. Treasuries, or 32% of the total. The Monetary Authority, which is primarily the Fed, owns $3.9 trillion, or 14% of the total. Money market funds own 12%, households 10%, U.S. chartered depository institutions 6%, mutual funds 6%, state and local governments 5%. All of the others hold less than $1 trillion of Treasury securities. They are exchange-traded funds, private pension funds, security brokers and dealers, state and local government employee defined benefit pension funds, property casualty insurance companies, government-sponsored enterprises, life insurance companies, non-financial corporate business, foreign banking offices in the U.S., holding companies, other financial business, non-financial, non-corporate business, credit unions, banks in U.S. affiliated areas, federal government pension funds, issuers of asset-backed securities, and closed-end funds. Those are all the groups that hold all of the Treasury securities currently. This chart shows the Treasury securities held by all these groups going back to 1990 in dollar amounts. But this chart is too crowded to be very helpful, so in the following charts we'll focus only on the largest owners, which we've seen already. Here they are, the 7 largest. These top 7 groups own 86% of all Treasury securities. This chart shows their holdings of Treasury securities in dollar amounts back to 1990. And this chart shows their ownership as a percentage of all Treasury securities outstanding. It's interesting to note that the rest of the world owned 55% of the total in 2008 and still owns 32% now. The Monetary Authority owned 26% of the total in 2021 and owns 14% now. So if we combine these two, the rest of the world, plus the Monetary Authority, they account for 46% of the total, nearly half, just those two investors. We'll look at most of these in more detail below, but before we do, I need to explain a key concept. Money is fungible. To understand how future government debt will be financed, it's important to begin with the critical concept that money is fungible, meaning each dollar is interchangeable with any other dollar in the system. Once money is injected into the economy, it can't be tied to any specific source or use. As money circulates through the financial system, it's continuously reallocated across different assets. The more liquidity that enters the system, regardless of its origin, the larger the pool of funds available for investment. Because money is fungible, a portion of that liquidity will ultimately find its way into Treasury securities. As a result, higher levels of liquidity make it easier to finance government debt than would otherwise be the case. The financing of government debt depends less on any specific source of funds and more on the total amount of liquidity in the system. With that concept in mind, and before we move on to how the government will finance the sale of an additional $25 trillion of Treasury securities by 2036, let's think about how the government will manage to refinance the existing $31 trillion of Treasury securities currently outstanding when they mature. When Treasury securities mature, the government must repay